The July-September corporate results of FY23 are in their last leg as India Inc. moves past another quarter of uncertainty and high inflationary pressures. The earnings show for the recent quarter was a mixed bag, as per experts, though the results largely came in line with what the street had expected, they say.
So I think the earnings were pretty much in line with the estimates. But we also need to understand that the estimates were downgraded by about 3% for the Nifty before the earnings actually started. But the performance of heavyweights like Reliance, TCS, HDFC, Infosys, ICICI Bank, all these were actually pretty much in line. And almost like 70% of the stocks which have declared earnings so far, they have either met expectations or slightly exceeded the expectations.
Within sectors, analysts say global commodity-based industries were the biggest drags during the quarter. As per Motilal Oswal, the profits of 32 Nifty companies slipped 2% year-on-year, led by global cyclical industries such as metals and oil and gas. Excluding these, it estimates the profits grew 25% year-on-year, led by the BFSI pocket.
The highlight of Q2 results released so far is the excellent performance of the banking segment. Banks can continue to do well in the next 2 quarters of this financial year also, since there is impressive credit growth in the economy and interest rates are rising. Also, asset quality of all the banks have improved substantially. The second best performing segment has been automobiles. But in automobiles, the premium segment has done much better. The IT segment results are also in line with expectations. There are concerns regarding the slowdown in tech demand, triggered by a possible slowdown in the US next year, but the slowdown concerns have not yet materialized in the results. The disappointment has come from commodities, metals, oil and gas, and cement. But this was on expected lines. Better than expected performance has come from the pharmaceutical sector. And this has been made possible by some very good results from companies like Sun Pharma.
That said, in the broader market, earnings beats and misses have been evenly poised for the Nifty 200 index so far, according to analysts. For instance, as per ICICI Securities, around 20 earnings beats from the Nifty Mid-Cap 100 index have firmly cushioned against 15 earnings misses from the Nifty Next 50 index. Besides, going forward, analysts expect FY23 Nifty earnings to be impacted due to continued rate hikes over the next few quarters.
The estimates are mostly not met in the case of Nifty. That has been the trend for almost now 5-6 years. So the earnings growth, our estimation is that the Nifty profits will be a little lower because of the higher interest rates continuing even over the next at least 2 to 3 quarters. So even though profits might grow, the margins would be a little less in that sense. So the Nifty EPS, I think, is about 820 to 830 kind of a levels.
Motilal Oswal also sees limited upside to the Nifty index in the near term, as it is now trading at around 22 times its FY23 earnings, 13% above the 10-year historical average. Markets will track global cues for direction today. The street will also react to Tuesday's Q2 results of Jubilant Food, Godrej Consumer and Bajaj Electricals, among others.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.